Hello, best ever listeners. Welcome to the best real estate investing advice ever show. I'm Ash Patel, and I'm with today's guest, Kevin Bupp. A number of years ago, I had the pleasure of being interviewed on Kevin's podcast, The Cash Flow Investor. He is also a returning guest on the Best Ever podcast. So if you Google Joe Fairless and Kevin Bupp, episode number 16 out of over 2,500 will show up. Kevin is joining us from Clearwater, Florida. He is the owner and president of Sunrise Capital Investors, a boutique real estate private equity firm that specializes in acquiring and managing niche assets like mobile home parks and parking lots. Kevin's portfolio consists of being a GP on over $100 million of assets under management in 13 states. He is also an LP on multifamily, self-storage, medical offices, and a dozen car washes. Kevin, thank you for joining us. And how are you today?
Thanks for having me, my friend. And excited to be chatting with you again. And it's funny you dated me, episode 16, because Joe's been doing this now for how many years now? You said 2,500 plus episodes, and so I'd probably be embarrassed to go back and listen to that that show way back then. But it's many,
you were
many
one
years
of the
back.
Pioneers.
Yeah.
Kevin, before we get started, can you give the best ever listeners a little bit more about your background and what you're focused on now?
Sure, absolutely. And just to I'll keep a long story short. I'm 43 years old at the present time, and I've been investing in real estate for over 2 decades. So I got involved at 19, bought my first property. First property by myself. I was working underneath someone else's tutelage for about 1.5 years, just learning the business, and I ultimately bought my first property at the age of 20, which was just a rundown row home in a small town in Pennsylvania where I grew up. And really, my mentor at that time, he was about 25 years older than I. And I only knew what he knew, right? Like literally, he was the only person I had ever met that had a very different lifestyle than my parents growing up. He was an entrepreneur. My parents were 9-to-5ers. And so I didn't try to reinvent the wheel. I mean, I literally saw his success that he was having. He had been there, done that for 2+ decades. And so I literally just followed exactly his processes. And for the most part, his process was to buy and hold. And so he had a lot of single family and small multifamily rentals. But I learned very quickly, Ash, that, I started with $7,000. I was tending bar at night and going to, school during the daytime hours. In between that, I was with him, hanging out, learning everything I could. But I learned very quickly on that first property, I used my $7,000 that I had saved up and had a private lender, put in the rest. And I learned very quickly that I couldn't keep that one for long-term cash flow because it would take me a very, very long time, with the, couple $100 a month of positive cash flow to ever save up enough to actually buy that second property. And so very quickly, I learned to kind of modify his business plan, and which led me to basically I would normally flip 2 or 3 properties, wholesale them, and then buy one and keep it. Wholesale 2 or 3, buy the next one and keep it. And I did that for many, many years. And fast forward about 7 years into that, I'd acquired about 150 single family rental properties, and then ultimately started venturing into commercial real estate, which is really where we've have focused our time and energy over the past, roughly, 13, 14 years. And that consists of, as you had mentioned, multifamily, manufactured housing communities, parking lots. And then I've got, passive investments in a litany of other commercial asset types. But commercial has been the core focus for, again, the last 13, 14 years.
Kevin, 150 single family rentals.
It was a nightmare.
My head's spinning.
It was a nightmare. My head spun too, and I realized there was a much more efficient way than that.
Kevin, at what point did you start taking on investors?
Literally the first property. And so it depends how you define investors, right? Because for the first many of years, it was more debt lenders, debt partners. And but the very first property and that partnership, or I guess not the partnership, but that relationship was a direct result of the mentor that I had been working with for 1.5 years. And that mentor, I worked for him for free. So I don't want it to sound like I was getting paid. I was his errand boy. I did whatever he asked me to do, get coffee, drop off contracts, pick up some supplies for one of his rental properties, anything, so that I could just be around him and listen to how he interacted with people, how he dealt with people, what he would say on the telephone and things of that nature. And so in exchange for that, we became really good friends. And, as a direct result, I got to really kind of get intertwined in his business network. And he had a few local high net worth individuals that had been, acting as the bank for him for many, many years. And one of those individuals basically stepped into my first deal, and they did the first couple of deals with me. And so really from that very first deal, I was using, I guess you could call it private money, or I was raising capital. And, you know, after a certain point in time, really it was when I got into, larger scale commercial real estate, did I really understand what syndications were. And again, that was literally only about 7 years ago is when we actually did our first official syndication. Prior to that, we had done multiple, maybe JV structures, some that probably might have been deemed a security, which we just didn't know any different. Right. And, but we've been raising capital I've been raising capital the entire time I've been an investor. So.
Got it. And Kevin, you're one of the few that I've interviewed that was an investor during the 2008 downturn. How did that affect you?
Oh, it was horrible. It was a really challenging time. The sky fell faster than what we could react to it. I was down here in South Florida, Tampa area, and then all the way south to roughly Fort Myers was where our properties were spanned in between. And Florida is a very, very different economy today than what it was back then. Much more diverse in nature. Employment was heavily reliant upon the construction industry back then, prior to the crash. And in addition to that, there was just a massive oversupply of housing being built here, especially in some of the markets a little bit further south, to where I am here in Tampa Bay. And that excess supply, when the music finally stopped, it created massive challenges for us. Not only from an occupancy standpoint, because ultimately what we ran into is that a lot of our tenants, we had 20-year-old vintage product. They had options. There was a ton of brand new homes that were built that builders started renting them out. They started renting them out to basically offset their costs and expenses because they weren't able to sell them at that point in time. And so we had a massive, massive challenge with occupancy due to oversupply. And in addition to that, we had to, lower our rents, offer concessions. And so I learned very quickly, and I always cringe when I hear people say that rents never go down. Rents didn't go down during the recession. It really depends on where you were, right? Every market is its own little silo. And I can promise you that rents were impacted, as were occupancies back during that point in time. And so, it was a tough time, Ash. I tried to work with all the lenders that we had at that point. And unfortunately, what I realized is that most banks, they weren't prepared for this either. And they didn't have loss mitigation departments set up. They had not planned on it being as bloody as what it was. And so, most banks weren't willing to work with us in that first year. It became very challenging. We had lots of notes called due, and we did our best to keep our head above water. But inevitably, majority of the properties went back to the bank, and we just worked through it over a period of time. It took really 4 or 5 years to really dig through and sort through the mess. And so, on the flip side of that, looking back, I learned a lot of lessons. And it made me a much stronger person. I had poor credit coming out of that, had no money, lost my personal residence, and just a very personally and financially challenging time. But I think it made me just a stronger person, both individually as well as professionally, and it really forced me to take a much longer outlook on what I really wanted to do, but also rebuilding what I had lost. And was there a more efficient way to do it? And so that kind of leads us to multifamily, like larger multifamily and manufactured housing communities. And that's really what made that pivotal moment occur, is that this took me many, many years as I was a single individual. I wasn't married. I didn't have kids when I had built my first little empire. And now I was with a woman who ultimately became my wife. I'm still married to her today. I knew we wouldn't have kids. And I was like, I need a more efficient way to rebuild this. There's got to be an easier way. And again, that's really where put my energy and resources into multifamily, which really quickly shifted to manufactured housing about a decade ago. So,
Yeah, my hat's off to you. I applaud you for turning a negative into a massive positive. You mentioned the banks weren't prepared for this. They're the ones that caused this.
Yeah, right.
But we have the luxury of seeing the remnants of the dot-com bubble. We have the luxury of seeing what happened when Lehman collapsed in 2008. So knowing what we know, how are you preparing for whatever is on the horizon. All we do know is the markets have become very volatile, and the Fed is talking about
Mm,
potentially a three-quarter point increase. So,
yeah.
what does that do to your outlook on assets going forward?
Yeah, that's a great question. I used to call myself a cash flow investor back then, and don't get me wrong, the majority of our portfolio produce positive cash flow, but there was a lot of additional inefficiencies that existed with that single family model. And I know that today there's a lot of technology, a lot more resources to help more efficiently manage single family properties. Progress Residential and Invitation Homes and those guys, like, they really perfected the scattered property management model, and it's just done better today, and more professional options are available today than what were available back then. And so, but backing up a little bit, again, always perceived myself as a cash flow investor, but really when it came down to it, and I was honest with myself, after the implosion happened, looking back, Florida was much more of a speculative market. And my investments, although we had low leverage points, taxes and insurance were fairly significant back then. We had just gone through a few major hurricanes, which made the insurance premiums go through the roof. And after you have one turn in a two bedroom, two bath, or three bedroom, two bath single family home, again, if you're honest with yourself, what you find is that they produce very, very little cash flow, even at a lower leverage point. And so, moving forward, as I look to rebuild things, I know two things had to occur. Number one, they had to actually produce real cash flow. They had to be self-sustainable with vacancies, with turnovers, and just really had to be honest with myself about the necessary reserves that were needed to, again, produce this positive cash flow on an ongoing basis, no matter what turns and vacancies ultimately occurred. But number two, looking back and just generally speaking, this is after talking to many investors that have been through many other downturns. And again, speaking back to my mentor, one thing that always stuck in my mind was that it's like, Kevin, there's really only one thing. No matter how bad a recession gets, there's really only one thing that can ultimately make an investment fail, and it's the debt. I mean, it's the debt. It's the debt load, not being able to actually service the actual debt load during a challenging time, during a downturn, if you lose occupancy or you have to lower rents or whatever it might be. And so, moving forward, we only buy assets that go through multiple stress tests. They have to actually cash flow. We put them through pretty aggressive stress tests. But in addition to that, we keep a very low leverage point. Our entire portfolio today, we're lower than 60% across the board. And I know that that might be leaving money on the table. We've got an asset that we're talking about right now, potentially refinancing, but now rates have gone up quite a bit. The 10-year treasury has jumped significantly over the past couple of weeks. And, we're at like a 50% leverage point on it. And so we've got a lot of equity just sitting there doing nothing, which is painful in and of itself. But I know no matter how bad it gets, I will be absolutely fine with that property, no matter what occurs over the next 2 or 3 years. And I don't have a debt term coming due for 4 more years. And so I'm in a pretty good situation there. And that allows me to sleep very, very comfortably at night. And so, again, just was able to reevaluate what I felt I could have done better, pre last crash, to what our business looks like today. And again, I have no stress in my body at all, other than, again, just watching the 10-year treasury jump, spike like crazy, and knowing that that's going to create challenges buying and also refinancing, at least for the initial period of time, until we see how things kind of settle out here. But hopefully that answered your question, Ash.
It does answer my question, and you're being very cautious due to the previous lessons learned.
Yes.
And we have that luxury. Kevin, what are your thoughts on what's going out on today with a lot of new syndicators raising a lot of money, taking down deals with very low margins where they have to flawlessly execute or the deal doesn't work? Are you seeing a lot of risky deals being taken down out there?
I don't know if it's hard to define what a risky deal is. I think the riskier aspect of any deal, whether it's good or bad in our eyes, is the actual sponsor and their expertise, and what their own personal balance sheet looks like, or the company's balance sheet. Can they weather a potential storm, or is it really just the LP's money that's at risk here? And really, there's nothing much at risk for the individual sponsor. And so, what does their track record look like? Does it go back prior to 2008? How did they weather that storm? And so, again, it's really hard to say what's a risky deal and not a risky deal. I would say that, again, I love multifamily, but we know that the margins have been incredibly thin for many years now, and there's lots of bridge debt out there, right? There's lots of floating bridge debt, and I think I think that the riskier component of all this, aside from just the bridge debt, are these the C class assets. There's a certain point in time, and the argument from the sponsors, at least over these last 2 years, especially in the C class stuff, is that rents will continue to follow inflation, and so rents have seen historical increases over the past 2 years. But there's a certain point in time, Ash, where tenants simply can't afford it. They simply can't afford to pay their rent, and so when do we hit that ceiling first and foremost? And if we hit that ceiling at some point during that bridge period where they're trying to execute a business plan, then how does that impact their ability to tie perm debt on or to even exit out of that asset before that bridge debt comes due? And so I think that's really where I think the big risk lies. And a lot of it's really going to boil down to the expertise of the individual sponsor and their team of how they can weather any potential hiccups that come their way.
Great advice. And I love when you said, look at the balance sheet of the sponsor. I don't think enough people do that.
Mhm.
Very important. If somebody is living paycheck to paycheck and they just raised $10 million, should be a red flag.
And if whatever's on their balance sheet is only attributed to like some sponsor fees that they just collected on that deal from the capital they raised, and if that's truly their nest egg, I'm not going to say it's everyone has to get started somewhere, right? And so I'm not going to say that's a bad thing. It's just, it should be a reason for potential concern, right? Dig a little deeper, get to better understand who that sponsor is, and get comfortable with them, and assume the worst. Assume that times are going to be turbulent. This is talking to, if you're like talking to some sponsors now, just know that times are going to be turbulent. I don't care what asset class you're in. There's going to be turbulence over the next couple of years. I don't know who knows how long, right? But like it's already rearing its ugly head in a very significant way right now. And so just be overly cautious and dig deeper than what you might have had to do, 3-4 years ago.
Great advice. Kevin, I knew you as the multifamily guy and the mobile home guy. And today I read car washes, parking lots, self-storage, medical office. Give me that evolution. How'd you get into all this?
Yeah, well, Ash, I mean, there's, we like to take a very strict focus, very siloed focus on our own business as GPs, right? And so that historically for the last decade at least has been manufactured housing communities. So we became, experts in that space, and that's all we did as far as on an active level. I've always, said that it's really hard to be, to be everything to everybody, meaning that, okay, we buy manufactured housing, we buy multifamily, we buy self-storage, we also buy we buy all this stuff, and we operate it internally, and this is our team, and that's challenging to do. Each one of those assets have some carryover skill sets, but a lot of them have their own unique nuances as well, and it's really hard to be the best to everybody or to every asset class. And so again, we've always focused on manufactured housing. Recently, we've we stepped into the parking sector. Again, a very boutique niche asset class, very fragmented in nature, which is what attracted us to it, and also not very operationally intensive based on how we have our business model set up. So it didn't really pull us away from really our core focus, still manufactured housing. But along all these last 10, 15 years, there's all these other asset classes that I absolutely love. I love the underlying fundamentals of medical office. I love the underlying fundamentals of car washes and self-storage. It's just, we never wanted to venture down that path and dilute our focus. And so I've got a lot of personal investments with sponsors that I've known for years that, again, have long track records. And I don't want to operate their self-storage, but I'll put my money with them and allow them to operate it because I love the asset class. So I think there's a million and one different ways to make money in real estate. And I like to have my portfolio diversified. And it's pretty challenging for me to diversify the portfolio as a GP, but I surely can do it by investing with other GPs that are, masters of their craft.
Out of curiosity, why is it that car washes are popping up everywhere now?
They are everywhere. And I think there's reason to be concerned there as well. I mean, I live in the Tampa Bay area, and there's one stretch of US 19 is a major north-south corridor. And there's a stretch, a stretch of 2 miles. And there's two that just opened up and a third one that I saw a sign to go for. And in fact, they're probably within a mile and a half of each other on the same side of the road. I'm like, how does that work? And why did the county even approve that? It just doesn't make sense. One's got much better ingress egress than the other two. And so my guess would be that that one does much better than the other, the other two. And is there enough population of cars that will ultimately allow all of them to thrive? But then the bigger question that I asked, I was talking with Dan Hanford the other week. They've got a car wash fund, and they've been buying car washes quite a great deal over the past couple of months. And I asked him, I said, the one thing I don't know if we know the answer to, but during a recessionary, because these car washes weren't around, maybe some, but I think that express model car wash, it might have existed somewhere, but it wasn't like it is today, where you see them on every corner. They've got pay $10 at your car wash or pay $40 a month for an unlimited subscription. Is that one of those budgetary items that people cut out when they cut back on spending? Like, do people care that much about having their car washed when they're worrying about putting food on the table? And I don't know the answer to that. So I think that's where the risk might come into play over the next couple of years with that car wash business.
And what kind of returns as an LP do you see in car washes?
Yeah, that's a great question. I've only been invested in them for just about a year, and so I can only speak to what it's looked like, at least over this past year. And they're high teens. I mean, they're cash flow machines if they're run correctly and the right business models behind it. But there's two of the operations that I'm in that have exceeded 20%. Just talk about cash on cash. I mean, 18% cash on cash returns over the past year. And the IRR, it's kind of hard to say at this point because there hasn't been a capital event, but they cash flow like crazy. But again, anything can cash flow like crazy if it's bought right and it's bought in the right location. If you're paying a premium for it and it's in an inferior location, you're not going to be necessarily able to replicate that same performance all the time. So
Yeah, thanks for sharing that. And Kevin, in my world, retail office, people they revere the triple net leases, right? They think it's the easiest to manage. But when I think parking lot, man, that takes it to a whole nother level. Can you dive into some of the details of parking lot investments?
Yeah, no, absolutely. And it's a very interesting asset class and has a lot of similarities to that of what mobile home parks were, call it 10 years ago when we started buying them. 10 years ago, it was predominantly a mom and pop industry with very few institutions or REITs in the space. And banks didn't fully understand the asset class, and again, just very fragmented in nature. Well, it's very much akin to what parking lots are. Again, you go down to Manhattan, or you go to downtown Chicago, you're going to find parking garages that are owned by REITs and large institutions, right? But in most other prime and secondary markets, what you'll find is that they're owned by maybe other investors that are maybe our side, professional investors that are our sides, but lots are owned by mom and pops, especially the surface parking lots that you'll find that they're owned generationally by, local families that have had it for 30, 40, 50 years and just been, it's just been a cash flow machine for them for many, many years. And so that was one of the interesting aspects. But the most interesting aspect for us, and again, this is kind of comparing it to mobile home parks and what we like and dislike about that asset class, was with mobile home parks, there's only a handful of professional management companies throughout the U.S. Very much the opposite to like multifamily, right? Multifamily, you can go to pretty much any market and find at least a handful of management companies that you can kind of shop. Mobile home parks, not so much. And we had originally built our own vertically integrated property management company. And as we were scaling, we considered actually passing it off to, there's a couple national companies in the space, in the property management side, and a couple regional. And we tried 3 out of the 5, and it was a horrible experience. And so we brought it back in, built out a much larger internal property management company, but it's a very operationally intensive part of our business. It's not the sexy part of the business, right? It's there because it's necessary. With parking, what we found is that there's an inordinate amount of parking operators throughout the U.S. So operators meaning, property management companies that manage the surface lot, that manage the garages. But a very, very small percentage, less than 5% of those parking operators actually own any of the real estate, which was mind-boggling to me, absolutely mind-boggling to me. And so what that meant is that we could go in and find an asset that had a value-add opportunity. And I'll give you an example of a value-add opportunity on just a a small lot that we bought up in North Carolina. Um, it was a 24 space lot in downtown historic Wilmington, North Carolina. Had been bought by a local doctor. He owned some other real estate. He bought it from the bank back in 2010. It was a failed development from 8. It was a carryover as an REO, and he bought it and he had his son managing the property. Collecting cash. They didn't accept credit card machines, and it was like in a vibrant part of town. It was right on a signalized intersection or signalized corner, a block away from the historic waterfront downtown. And the year that we bought it about 2 years ago, and its prior full year NOI was it was roughly $38,000, and he only paid $400,000 for the property. So he was doing great. I mean, it was a great, unlevered 10% return. And we looked at it and realized that, number one, I don't even carry cash half the time. I only use credit cards. So I wouldn't have been able to park there because he would have never accepted a credit card from me. So he's missing out on all this opportunity. And we found that there was a number of operators locally, one having the biggest presence in that local marketplace. And we had we put out an RFP to all 3 of these different operators. And we were really looking for a triple net lease. That's what we wanted. We really wanted a passive model in the parking lot space. And ultimately where we landed was with the biggest operator in this area. They knew the data. They knew exactly how many turns this parking lot could do on a daily basis. They had a dynamic pricing model in place, which the old owner didn't. And so they would charge higher flat rates and really, really busy parts of the year where there's events happening, a lower rate during the slower parts of the year. And they signed with us. We paid $695 for this lot. The seller won based on what he paid. And we've got a $72,000 triple net lease in place with 3% annual increases for the first 5 years. So kind of a win-win for us, and huge value add play, but it's a kind of a set it and forget it now. And so there's a lot of opportunities just like that one in the parking sector where they're just being mismanaged. They're not being operated efficiently. They don't have technology in place to even accept credit cards. And so there's a number of other of those that I can speak to, but like that's the attraction of that space. It's so fragmented that, and that was a small deal, but there's many other deals out there that are just like that just, installing technology, having a dynamic pricing model and getting a better operator in place that can kind of run the day to day. That's got that, infrastructure. They got that local market knowledge. Literally that is the biggest value add component in that space. And there's many opportunities out there that are sitting there waiting for the picking. So
I love that out of the box thinking. Good for you. Kevin, what is your best real estate investing advice ever?
Yeah, that's a great question. I think this really sticking to the fundamentals. And I feel like that went out the window, Osh. The fundamentals have gotten thrown out of the window over the past like 3 years, especially during COVID. Everyone kind of pulled back a little bit, in March, April, May, not wondering what was going to happen. And then we just saw this massive, inflation take hold, and man, it's just, it's been like a rocket ship for the past year and a half. And, one of the, ultimate results of that are these massive double digit, rent increases, over this past year and a half. I mean, it's just been absolutely insane, especially in certain markets across the country. And a lot of the prior underwriting fundamentals have kind of been thrown out the door, assuming that these, double digit rate increases or rent increases are going to continue on. And I'd say just, if anything, just pull back, know that, don't get the anxiety that there's not going to be another deal. Or if you don't buy this one, well, not going to come across another deal because this is a 1 in a million. Forget that. Like, just know that there's always another opportunity. And in fact, if anything, just put on, slow down a little bit. Don't ignore those fundamentals, and know that in times like this, it might take a while for us to see it get flushed out, but like, this is when the real opportunities are made. I think let's talk about all the guys, or all the, the people that made the most money in multifamily over the past decade. Looking back, a lot of them, they were ready to rock and roll in 2010, 11, 12, 13, 14. And that's when, if you look at their track record, they're still buying today, and you look at the ones they've gone full cycle on, look at the returns that they had back on those deals that they bought, shortly thereafter, that last recessionary period. They absolutely cleaned up shop. And so I would say stick with the fundamentals and just be true to yourself, and be willing to wait for the right opportunity to come along, because it will. I promise you it will. And don't overextend yourself buying something just because you feel the necessary need to go buy something because that's what everyone else is doing on Facebook or Instagram. So
I love that advice, and temper your expectations. Back in '99 when that tech bubble was booming. Very reminiscent of today, where I was probably in my early 20s, maybe 22 years old. I'm 46 now. So I remember everybody was investing in stocks. And if you didn't, you were an anomaly. It's like, hey,
Yeah.
why are you not putting your money in the market? Which a lot of people that are newer to real estate think this is the greatest gold rush ever. And again, people who have lived through a couple cycles know that that pendulum goes back and forth and things eventually will equalize. COVID accelerated a
Yeah.
lot of different things. It accelerated the move to suburbs, away from city centers, people traveling, working from home. But my opinion, again, I think yours as well, is things tend to equalize over time.
Well, look what's happening to the city centers. People, I mean,
Yeah.
Manhattan is seeing an all-time high. Like everyone couldn't wait to leave Manhattan. Like that in migration to Florida and all these other places from Manhattan. Like those people were not going back to the city. They're back in the city now. In fact, there's more people that want to be in the city than can actually fit in the city, and
Yeah.
rents are at an all-time high. So you're right. Everything tends to equalize over the long term, and so just be aware of that, and just really be cautious as we move through these next couple of months, and potentially even a couple of years as we work to really unravel what we've kind of built up here, not just even during the pandemic. I don't think we ever really allowed things, the Fed never really allowed things to crash as hard as it probably should have during the last recessionary period, and ultimately kept pumping money into the into the market, and then the pandemic just accelerated that. And so it could be a time for reckoning. Who knows what the Fed's actually going to do when shit really starts hitting the fan? Time will tell. But we know that things are slowing. It's happening again as we record this. Today is what, the 15th of June, and the Fed will announce today. They originally said it was going to be 50 bips, and then just a couple of days ago they said, it's going to be 75. And so we'll see how many more times that happens and where we end up in a couple of months.
Yeah. Again, great advice. Kevin, are you ready for the best ever lightning round?
Absolutely.
Let's do it. Kevin, what's the best ever book you recently read?
Yeah, that's it. And it's a book I've read many. I read like 2 or 3 times a year, and it's a short, easy read. It's The Go-Giver. It's a phenomenal book.
And Kevin, what's the best ever way you like to give back?
Yeah, so I participate in 2 different local nonprofit organizations that are local to me that I've been helping for the last decade or so. And so I put together a 280-mile bike ride each and every year that supports these 2 local charities. It's called 72 Hours to Key West. Started it 11 years ago, and myself and 74 other cyclists ride from Fort Myers Beach down to Key West each and every fall here in Florida. And it's just a phenomenal way for me to give back, but also do it while really enjoying a hobby that I come to love. So,
I love it. Do you have to ride back?
no, no, we take a bus back, and
All
haul the
right.
bikes back in the trailer. No.
Leaving Key West on a bicycle might be a challenge.
Yeah, exactly.
Awesome. Kevin, how can the best ever listeners reach out to you?
Yeah, the best place to find me, my website, kevinbupp.com. In addition to that, Ash, I'd love to, if you don't mind, I'd love to give away a free copy of my most recently written book, The Cash Flow Investor. They can go to kevinbupp.com/free book and grab a copy of that. But yeah, go to kevinbupp.com either way if you want to reach out to me, listen to my podcast, or use the contact us page to get to me directly.
Incredibly gracious of you. Kevin, thank you for sharing your time. You're one of the legends in this industry, almost a 20 plus year career in real estate. Thank you for sharing your story today. Thank you for telling us what you're getting into in the future and just your overall outlook on the market. It's been a pleasure having you today.
Thanks for having me, Ash. This is amazing. And keep doing what you do, my friend. You're helping a ton of people out there. So thank you for having me.
Likewise, brother. Best ever listeners, thank you so much for joining us. If you enjoyed this episode, please leave us a 5-star review, share the podcast with someone you think can benefit from it. Also, follow, subscribe, and have a best ever day.